You're tuned in to your ultimate pit stop, Piston Pundit, where we don't just shift gears on cars, but on the economies that drive them. And today, we're downshifting into a major jolt to global finance, the euro's unexpected torque surge against the US dollar. In April 2025, financial markets witnessed a rally that few saw coming. The euro hit a 3-year high while the dollar skidded into trouble. The spark? President Donald Trump's aggressive new tariffs. And just like misfiring a cylinder under full throttle, the backlash was immediate, loud, and global. Investors fled, markets wobbled, and economic power began to drift. Let's pop the hood on what really happened, starting with the tariff-fueled firestorm that kicked it all off. Trade tariffs and the ignition of currency chaos. April 2025 saw Trump bring the heat, slapping a blanket 10% tariff on all U.S. imports, with a scalding 145% rate aimed squarely at China and a 20% sting for the EU. Washington framed it as a defense of American industry. But Wall Street wasn't buying. Within days, the euro rocketed from 1.0807 to 1.1351, gaining over 5% by April 11th. That's no minor bump. It was a clear sign investors were pulling the emergency brake on U.S. assets and steering toward Europe's steadier economic climate. The European Central Bank's consistent policy approach contrasted sharply with the turbulence coming from Washington. Even a selective 90-day tariff pause didn't ease the pressure. China was excluded, which signaled deeper instability. The U.S. dollar index, DXY, dropped below the symbolic 100 mark, settling at 99.78, its weakest since mid-2023. Currency markets are like a dashboard warning light for global trust, and this one was blinking red. What began as a flex turned into a fiscal misfire. But that was just the first tremor. As confidence cracked, the financial system itself started showing signs of distress. Market mayhem and financial freefall. Once the tariffs hit, financial markets didn't stall, they spun out. U.S. Treasury bonds, long considered the gold standard of safety, turned radioactive. On April 2nd, yields on 10-year Treasuries spiked from 4.2% to 4.43%, the sharpest jump since the 2008 crisis. Even 30-year bonds saw their steepest 3-day climb since the early 80s. A cascade of unwinding trades, basis trades, swap spreads, unleashed panic. Investors hit the eject button, bailing out of U.S. debt like a turbocharged downshift. Meanwhile, the stock market took a gut punch. The S&P 500 shed over 10% in 2 days, the sharpest plunge since COVID. The Dow dropped over 3,000 points across back-to-back sessions. In total, more than $6.6 trillion in market value evaporated in under a week. Gold soared past $3,223 per ounce, while whispers grew louder that China and Japan might trim their U.S. Treasury holdings. The verdict? Global trust in Washington's fiscal playbook was running low. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now let's shift gears from market charts to kitchen tables, because the pain didn't stay on Wall Street. Main Street meltdown, inflation hits home. But this wasn't just Wall Street's headache, it was hitting household budgets coast to coast. Yale's Budget Lab estimated the average U.S. household would pay $3,800 more per year due to rising import prices. From kitchen appliances to car parts, everything got pricier. The auto industry in particular felt the squeeze. EV battery shipments faced delays, while OEMs forecasted price hikes on critical components for both combustion and electric drivetrains. Inflation surged by an estimated 2.3% for 2025, fueled by tariffs, supply disruptions, and rattled consumer confidence. The Fed cut its GDP projection from 2.1% to 1.7%, and the OECD warned of just 1.6% growth in 2026. All this while, the U.S. battled a $1.8 trillion deficit. A weaker dollar raised borrowing costs, making the climb steeper. Meanwhile, foreign currencies like the yen and Swiss franc gained ground. Confidence had cracked. For everyday Americans, it wasn't abstract. It was higher gas prices, steeper interest rates, and shrinking savings. And when the economy starts to wobble, the auto industry feels the shock, from factory floor to dealership lot. But while Americans felt the crunch, U.S. allies weren't just waiting and idle. They were drafting new blueprints of their own. Allies downshift from Washington and recalibrate trade routes. When tariffs hit like a speed bump at 80 miles per hour, allies knew it was time to change lanes. Canada and the EU, long-standing U.S. partners, began steering away from their traditional dependencies. Trump's 25% tariff on Canadian goods, plus 10% on energy, sparked Ottawa's $29.8 billion retaliation. But this wasn't just tit for tat. It signaled a deeper strategic pivot. In early 2025, former Prime Minister Justin Trudeau met with EU leaders to deepen trade ties, bypassing U.S. unpredictability. Under CETA, bilateral trade had already risen 65% since 2016. In 2022, EU exports to Canada reached $49.1 billion. Canada's to the EU hit $34 billion. The goal now? Diversified supply chains, stable economic partnerships, and even shifts in defense procurement. For automakers, that means new sourcing maps and fewer US-centric contracts. While Trump doubled down on America First, allies drafted a fresh trade blueprint, one that leaves less space for Washington in the driver's seat. But if allies were recalibrating, America's rivals were redlining their engines for something much bigger. BRICS block Revs toward a post-dollar world. While allies rerouted, rivals revved up. BRICS nations, Brazil, Russia, India, China, South Africa, saw an opening. Trump's protectionism accelerated their de-dollarization plans. Trump threatened 100% tariffs on BRICS members, promoting reserve currency alternatives. But that move fueled their efforts. China ramped up yuan-based trade. India and Brazil inked energy deals in local currencies. The IMF reported a 1.8-point drop in the dollar's share of global reserves, with alternatives and gold on the rise. Digital currency innovation also surged. Russia and China are developing a BRICS digital coin. Central banks across Asia and Africa are diversifying reserves. Even the IMF and World Bank now acknowledge the global trend toward regional payment systems. This isn't about one currency replacing the dollar. It's about creating a diversified, resilient financial highway, one where no single driver controls the route. Ironically, Trump's hardline stance may have shifted the gears faster than anyone anticipated. Final lap. Has the dollar blown a gasket? The global engine is clearly in transition. What began as a campaign to revive American industrial power now looks like a misfire. Allies are testing new roads, while BRICS are building fresh tracks. This isn't just visible in reserves and bond yields. It's being felt in sourcing strategies, pricing structures, and long-term planning in the auto world. For automakers, this touches everything: EV battery costs, transatlantic logistics, and pricing under shifting currency risks. Now let's open the hood and hear from you. Do you think the US dollar is truly losing its dominant gear, or just stalling before another surge? Will Canada and Europe's pivot reshape how automakers plan global supply chains? Is the BRICS financial push a serious challenge, or a symbolic rev? Drop your thoughts in the comments. Whether you're a backyard mechanic or a policy junkie, we want your take. If you enjoyed this ride, don't forget to subscribe to Piston Pundit, your ultimate pit stop for vehicle updates, economic roadmaps, and every twist in the global automotive story. Thanks for watching. Until next time, keep your wheels turning and your insights sharp. You can now check out any of the videos on the screen. There's plenty more to explore.